Everything in this video is not intended as financial or investment advice and is for educational purposes only. I'm Josh Olszewicz, the head of research at Valkyrie, and let's take a look at the midweek market update. I'm going to start with some on-chain stats for BTC and ETH and then move into some technical stuff. Obviously, the big news over the past week has been and continues to be the Russian-Ukraine conflict and how that's affecting markets globally, and or how markets are already primed for pullbacks globally. And this is sort of an excuse to move or an event catalyst on price. There's been a lot of discussion between my personal friend group regarding, why do events in Russia and Ukraine matter to US markets? And like I said, I think partially it's acting as a risk-off catalyst in general. Crypto's global, US markets are global. Everybody's connected these days, everything. Obviously, energy costs rising as well. So there's a lot of knock-on effects, I guess you would say, potentially acting as additional bearish headwinds in the near term. But if we look at on-chain stats, they tell you a somewhat of a different picture, I'd say. Certainly not as bearish. Something I always like to do is look at, what does price look like now? What did it look like on the most bullish periods? What did it look like in the most bearish periods? What was on-chain activity? What were people doing in these periods now relative to previously? Can we explain away certain things? Can we explain why certain things happened and when they happened? So this is active addresses. These are addresses that have moved in value over the previous day in the orange line here. And in general, it makes sense if you're bullish on price. You see rising active addresses. When you're bearish on price, you see bearish declines in active addresses. What's important for me here is that when comparing to 2017, for example, where you see everyone basically leave all at the same time, we're definitely not seeing that here. And you could say, well, we're not seeing that yet. That's fine, but we're also not seeing it yet. Period. End of sentence. And if we zoom way out, if we go all the way back to the beginning of time, you can see how things looked even throughout 2014, 2015. We were still getting additions in active addresses. So this can diverge from activity. It can catch up. It can lag, right? You could argue that this rise in on-chain activity from 2014 to 2015 to 2016 eventually caught up with price. And that's where things started to take off. I think that's what the on-chain analysts will tell you, is that this stuff finally started to get priced according to its on-chain activity in 2016. And that's one argument you could make here, I think, with the data available. So I think we are doing a bit of a repricing regarding on-chain activity, but ultimately you want on-chain activity to continue to rise over time. So it's binary. Are we rising currently? No. Are we declining? Kinda. Are we at lows? No. Certainly not a ringing bullish endorsement, but it's not falling off the table like it had been in previous years. So what I'd like to see going into Q2, especially, my whole seasonality argument is that, again, if we look at historic periods, when is price the most bullish? When is it the most bearish? Is there a pattern? Does price care about the calendar year at all? Historically, Q2 has been the most bullish, along with Q4 for BTC. Q2 just across the board for alts in general, altcoins. I know I'm kind of all over the place here, but this is all what's going on in the back of my head. Is if Q2 is going to be bullish, what do on-chain metrics look like going into Q2? Do we see rises in on-chain activity going into Q2, throughout Q2, that sort of thing? Will that support price in Q2? We can also look at transaction counts, which for BTC have really been declining since 2019. And with BTC specifically, it's a bit different because there are other ways to transact besides just on-chain now. If you're using Lightning or you're just holding coins and an address. For me, ETH and transactional activity is more of pure metric than Bitcoin's, because Bitcoin's narrative is not transactional activity per se. It certainly can handle it. It can do it well, but it's not where the party is happening relative to things like DeFi and NFTs. So even in the most bullish period of price, you're seeing this, I'd say, relative divergence between transactional activity and price. We did not see, in the most current all-time high, a rise in transactional activity on chain like we did in 2018. And that could possibly be related to a general dilution of options for people, retail included, as far as what they can transact, where they can transact, how they're onboarding, how they're off-ramping into DeFi, that sort of thing. A bunch of different reasons, and I'll look at the ETH stuff in a second. But for me, active addresses is the more important metric for BTC, along with something like addresses with a non-zero balance. So this is fairly self-explanatory since the beginning of time. Again, if we look at active addresses that haven't ever had a balance versus do, again, this is binary. You either exist or you don't on the blockchain. And active addresses or non-zero addresses approaching 41 million in total on BTC. And this is in spite of price. Unlike this 2017, 2018 sort of gold rush and exodus, you're not seeing that here currently. And that's certainly encouraging. To me, it says there are hodlers so far who haven't left, and we can look at that in other ways as well. We can also look at hash rate, which has been absolutely skyrocketing. The slingshot has been insanely impressive as dirty China coal hash rate is being converted into clean North American renewable hash rate. One of the concerns I had previously for many years was the concentration of hash rate in China. There was no good retort to that other than the network being decentralized, maybe not physically, but pools and miners could decide where to point their hash rate, right? So to see hash rate getting shaken up continuously and the network not minding it at all, as far as activity is concerned or availability of the network, the network lives on another day. The network doesn't care where the hash rate is. Very encouraging in that regard. These dotted lines are hash rate here, and you can see that along with, block reward halving, along with price rising, hash rate rising as well, break-even prices for mining baked into this as well. Lots of calculations on electricity and which ASIC you're running and what your uptimes are. All that stuff gets baked in. But some estimates for certain miners, their break-even costs are 10K or less. So to me, that suggests hash rate will continuously be added here until you're pricing out the less efficient miners who just don't mine at a profit because of difficulty, not because of Bitcoin price. I also like to look at hodl waves, which measure when coins have last moved. You can see in these colder, cooler waves up here, these are basically glacial coins. These are coins that haven't moved in 7 to 10 years or 10 years or more. And that's continuing to be a growing part of the total chain. And in general, when you see a lot of on-chain activity for unhodling or hodlers who are selling, people who previously held for a significant period of time selling, it typically corresponds with local tops in price, typically all-time highs in price. Everybody has a price, whether it be 100,000, 200,000, 250,000. On aggregate, you can see that on chain when you see these big spikes in coin movements. So I do like this graph, but I think the better graph is actually the weighted realized cap. So this measures the price at which the coins last moved and sort of weights these bands. So it discounts the older coins more and then it doesn't really influence the calculation too much. And again, you can see here at local highs, at all-time highs, you're seeing massive on-chain activity for people realizing those profits essentially. And something else to pay attention to in a bear market, this stuff drops all the way down. You just don't see a lot of realization of profits through accumulation periods or bearish periods, obviously. And you could argue that as we approach just sideways doldrums, 30 to 60K, that you're going to want to see activity for these bands based on age just go all the way down, to less than 40%, 30 to 40% of the total chain moving in the past 6 months. So whenever that is, this is related to dormancy flows. It's related to coin days destroyed, if you've heard of any of those metrics before. And we can look at the hodler's net position specifically, and we can see that, again, the story is being told. These are either individuals in aggregate or specific individuals moving a significant chunk of price at highs, at local highs. In 2021, this was a Chinese miner moving a significant amount of coin. In 2017, much of this was Roger Ver, Jihan Wu, Bitmain, a lot of OG Bitcoin people in the face of Bitcoin forks, Bitcoin infighting, Bitcoin 2x, whatever, Segwit 2x, all sorts of stuff happening around this time period. So sometimes it is specific whales, and sometimes it's just in aggregate what's going on. But nevertheless, we are seeing accumulation here. We aren't seeing a drop in holder position change. Now, again, this is with the caveat yet, because obviously if we start to break the range price-wise, as we did in 2018, you see this big chunk of capitulation on those lows. So it's certainly something to look for. All my analysis is if this, then that. So if we do break lows and we see capitulation, that's usually a better sign than not for a bottom in price. If anything, this represents holder capitulation in a different way, in that these holders had their price that was reached, right? You can see over time, this accumulation slows down. These spikes will probably slow down over time until that energy, those coin days destroyed, get stored once again. So moving on to Ethereum, same type of analysis. Ethereum's active addresses flat, still downtrending. Again, if you're bullish into Q2, if you're looking for bullishness anywhere, you generally want to see and expect increasing on-chain activity. So it's no surprise that on-chain activity is a bit muted or down here since November 23rd, along with price. Transactional activity as well. Same story in general, just declining slowly since November 23rd-ish, late November. Nevertheless, still above previous all-time highs in 2018. So there's still a ton of on-chain activity for ETH relative to what happened in the post-ICO boom, where ICOs basically fell apart and realized they couldn't deliver on empty promises and just sort of fire sailed their treasuries continuously from really early 2018 to early 2019. Here, you're still seeing all that on-chain activity regardless of price again. So that, to me, is definitely a strength, along with addresses with a non-zero balance. On ETH, this is at 75 million. So almost double what BTC is here. Now, the networks are different. You use the networks for different things. For me, ETH has a job more than just being held. That's just my personal belief. Everyone's different, but that sort of explains putting your coins to work in a way where BTC for me is, I'm smog, I'm hoarding, I do nothing with them. They're important to be in my possession. Just to give you some sentiment analysis, perhaps, of the differences people use those coins for. And hash rate on ETH is just skyrocketing astronomically. Both BTC and ETH double in their hash rates, respectively, since the Chinese miner exodus. And what's interesting about ETH is that it's set to go to proof of stake eventually, maybe this year, maybe next year, we'll see. But probably within the next 3 years, certainly, I'd expect something to turn over here. They'll be the biggest network to ever do this by market cap. Certainly the biggest network based on the number of developers and people and apps and dApps that need to switch over, all this other stuff, how it's going to affect everything. I don't think anybody really understands too well at this point in time. But that also means all this hash rate is going to go to zero. This is going to be the turkey weight into Thanksgiving. That famous graph. The turkey gets fatter and fatter and fatter until it's slaughtered for Thanksgiving. So this hash rate is going to go to zero because there will be no proof of work on the chain once we go full proof of stake for Ethereum. And we can also look at the number of total ETH being staked ahead of that transition. And it's currently almost 9.4 million ETH. So again, there's a bit of a divergence here between the available float and or what's on exchanges. Not even mentioning EIP 1559. That affects issuance. It affects inflation as ETH is burned. And you wouldn't really know it. All these positive factors for ETH in supply metrics, economics, you wouldn't really know that or see that based on price, because really it's just been following BTC ever since early to mid 2021. Flipping gears to technicals, observations, we're still pretty coupled with legacy, traditional finance. If I call it legacy to a legacy person, they tend to get upset. So I try to say traditional finance, that's more neutral. To me, it's just legacy. I don't think there's a slight there, but we're still coupled to S&P, to NASDAQ. We attempted a decoupling early February, but all of that appears to have faded away. So there's degradation of the coupling, there's recoupling. We're not as tight as we were mid-January perhaps, but it's still very much moving together. And if we look at the VIX volatility index and compare that to BTC, for example, we usually see spikes in the VIX matching lows for BTC. So it is no surprise that we're seeing near-term bearishness with a rising VIX. Ultimately, we need the VIX to calm down, the fear index, as some people know it. And you know, there's two sides of this coin. You can say, all right, if I'm a buyer, if I'm looking for buys, I want the VIX to be high. I want to see this crazy capitulation candle. I want to see crazy volatility. I want to see wicks, right? If you're looking to become an entrant into a market like this, you certainly wouldn't want to buy it at all-time highs. So depending on who you are, how long you're going to be here, what your plan is, seeing something like this may be super encouraging to you as you're looking to become a market participant, perhaps. But ultimately, price-wise, BTC does best when the VIX is quiet, when it's flat, when it's declining. If we look at on lower time frames, this pitchfork that we've been in, this channel essentially, pick 3 points, you get a rate of change. And we've been unable to shake this this channel. We had a chance, we had an attempt. I was bullish last week, talked about that setup any place I could because it looked good. I took the trade personally. I got stopped out personally. That's why stops exist. But some people going into that, told me, I don't know why we're bullish here. There's no reason to be bullish here. And that's fair. But my retort to them is, well, the setup looked good enough to trade. I'm not going to short that setup ever. It just isn't a structure that I would plan on shorting. But for now, we're still stuck within this this downward channel. So should we reverse this, I would expect bullish momentum to come back here. And we can always zoom way out. Again, depending on your market participation, you're either looking at this thinking, man, I can't wait to start dollar cost averaging, or you're panicked if you're in from the highs, right? There's all sorts of people here for all sorts of different reasons. But if we look at the 2-year MA and the 2-year MA multiplier in the red here, we're getting closer and closer and closer to that buy zone territory, that oversold territory. If we look at this as an oscillator, oversold, overbought, somewhere down there around 35,000 or less would start to kick in and satisfy conditions for oversold situations based on the prior 2 years trading history. Top side of that, well north of 140K. But that, from peak to peak takes time. So keep that in mind here. This is definitely not a get-rich-quick scheme for sure. And if we look at the longer-term pitchfork, bullish pitchfork here, we're still within that. We're still within this 2021 range. It's important as things look bearish, as you look at these percentages since November, we're still satisfying prices we've seen within the year. And as we snake in between these levels, for me, anything above 45, when we start to get more bullish, that's where the 200-day moving average is. That's what we're back into this rate of change. Into Q2, that's where I want to be. I want to be at 45, on our way to 51, righting the ship, as it were. Now, if we aren't, if we start to break down below this rate of change, break below the pivot, then we're in for some pain in the near term. And this is the 2-year MA in the background here. So trend metrics, not quite on our side just yet for bullishness, but it's something to watch for into Q2. And like I was mentioning, these inverted head and shoulders setups, if you're familiar with technicals and chart patterns and voodoo nonsense like that, you likely saw this and got excited because we saw this consolidation period that looked reminiscent of this type of fractal. But ultimately, like I said, it broke down below the right shoulder, and you don't want to see that. Not only that, but really the trade never triggered because this is, again, if it's an if this, then that, you want a breakout candle above the resistance levels. And you never really got that past Valentine's Day, right? Past the 14th. The market was trying to tell you, yeah, this probably isn't going to go higher anytime soon. And if you don't like chart patterns, you can always use something like MAs and fractals to look at the levels here. And this will print stop losses for you. It'll print entries for you. And it says, if we make a higher high, there's an entry. And it says, if we make a lower low, there's your stop loss, right? So it has everything there for you. There's no subjectivity really at all. It's a get ready, get set, go sort of setup. So right now the MAs are cross bearish for both BTC and ETH here. So for me, this is a consolidation failure. And now we just wait and see as to what's going on here. We may double bottom, we may equilateral triangle. There's all sorts of chart patterns and things we may create here, but ultimately what you don't want to see is lower lows. beyond the current local low, and especially beyond that range low. For ETH, we're actually already within that 1 year, in this case, MA in the green, 1 year MA multiplier in the red here. Best we have is looking at prior to 2017 to present data here. Doesn't tell you duration, doesn't tell you how deep it'll go, but it does give you a pretty good idea of oversold, overbought conditions. And if we look at this 5200 cross, again, if I'm trying to paint what this could possibly look like going into Q2, I'm looking at the potential for some sort of reversal-y type pattern, right? It doesn't have to be perfect. Maybe it's triple bottom, maybe it's double bottom, maybe it's nothing, right? Maybe it's just an ascending triangle. But we will very likely be, if we're bullish, if this then that, above 3100 with a bullish 5200 cross pending, above all this volume, which is what this is representing here. So currently the bottom side mega support is around 1850 for ETH. That's where all the previous wicks were in May, June, July. That's where most of the volume sits based on the 2021 range. So we could very well explore that area and still be okay for Q2. And lastly here, I just want to look at dominance, Bitcoin dominance, which continues to curl up and to me signifies risk off within crypto. If BTC is risk on relative to legacy traditional finance, then BTC is risk off relative to altcoins. So we're seeing rotations based on dominance back into BTC and or just BTC being not as bearish as coins that aren't BTC. And you've got potential, 5200 cross coming up here, potential inverted head and shoulders, triple bottom, whatever you want to call it. So there's some technical evidence on your side here for bullish dominance. And is it tradable? Is it leading? Is it lagging? I don't know, but it does tell me that alts probably aren't going to do too well if this thing starts to break up past 45. And very likely we get back in this 60 to 70% range on dominance. And it's reminiscent of DXY, which completely different universes arguably, but DXY is the US dollar index. And the technicals look very similar as to how they've set up and played out over the past year plus here for DXY. So that's all for this one. What'd you like? What'd you hate? What I miss? Let me know. Like, dislike, comment, share, subscribe, and happy trading.